My name is Heaven, and if you're new here, I'm a CPA, have been for almost 2 years. I'm a state auditor with the state of Tennessee, which is an accountant, if you're unfamiliar. I've gotten some growth in my channel, and a lot of people are not accounting related, so welcome. If you're listening on this video, this is fantastic. You want to know what auditing is. This video is not for the accounting professional. This is if you work in tax or if you've graduated in accounting. You're already gonna know everything I discussed in this video, but this is gonna be for the non-accounting professional, or even if you're thinking about getting an accounting degree. I just wanted to briefly touch on the auditing profession, but mostly just explain what it is.
Also, this is the 4th time I've tried to film this video today. They keep pressure washing my apartment over and over again.
It is Friday. I had a very productive, awesome work week this week down at my client in Chattanooga, but it was very exhausting. We worked 10-hour days. I hung out with my friends after work every day, and then I actually talked my audit team into doing a little team bonding activity. We all went to Top Golf after a really long day at work. So it was just a lot. It was a really good week. So last night when I got home at 5 p.m., I went straight to bed and literally slept for 13 hours. Oh my gosh. Woke up today not knowing what day it was, but feeling absolutely fantastic. So I wanted to take advantage of this great vibe that I'm feeling today and film a really helpful video for some of you guys to talk about what auditing is. So let's get started. I should first off explain that I'm talking about a financial auditor and accountant. That's what this whole video is going to be about. So if you're wanting to know more about a night auditor at a hotel, I've recently learned that that's a thing. A lot of people have tuned into my videos wondering what hotel I work at. A night auditor's responsibilities include checking in guests, handling the requests, taking reservations. They might also reconcile accounts, process invoices, and prepare paychecks. That is a different role than what I'm going to be talking about. Some things may cross, but just giving you guys a heads up, that is not exactly where I'm coming from. Also, auditor can mean somebody who helps people hear, like auditory hearing. I learned that when one of my friends said she was getting her master's in auditory. I don't remember the exact word, but she was like, oh my gosh, I want to be an auditor. And I was like, I am an auditor. And then we realized we're talking about two completely different things. So that was cool. Also completely unrelated to the option to audit a class when you're going to college. Auditing a class just means that you're going to sit in on the class to physically learn the knowledge or to learn a new skill, whatever the class is, but not actually get college credit for the class. So that's how the word audit can be thrown around and used. So the Merriam-Webster definition of audit is a formal examination of an organization or individual's accounts or financial situation, the final report of an audit report, or a methodical examination or review. AICPA's definition of an audit is the highest level of assurance service that CPA performs and is intended to provide a user comfort on the accuracy of financial statements. The CPA performs procedures in order to obtain reasonable assurance about whether the financial statements are free from material misstatements. So that's what we're going to be discussing today. So within auditing, there are several different types of auditors that are still within the realm of accounting. I'm an external financial auditor, so that's going to be the majority of where I'm coming from. But you also have an internal auditor, which means that person is an auditor for a company, checking everything within their company. So as I'm editing this video, I'm already finding some pieces that I forgot to mention. So I'm going to call these afterthoughts and just pop up in a mysterious bubble on the bottom left of the screen. But internal auditors work within an organization, so they are employed by the company, but their job is to make sure that internal controls are being used as they're designed to be performed. So they'll be performing routine investigations. They're going to be checking in on all parts of the organization, making sure no non-compliance is happening, no fraud, waste, or abuse, no illegal P-card activity, all the stuff that should not be happening. Internal audit is going to be making sure before the external auditor gets there, because if the external auditor finds it, it's just a whole lot worse than if the internal auditor found it already. And I know that's barely even enough to understand what internal auditors do, but if you want to know more, if you're interested in that field of accounting, my girl Steffi is a longtime accounting YouTuber and she works in internal audit now. I believe she's an internal audit manager, and she goes way more in depth about what internal audit does. So check out her channel. She is awesome. Love her so much. And then there's also performance auditors, and that's like the majority of governmental auditors or performance auditors. And we'll touch more on what that means later on. Also, if you're completely unrelated with the whole realm of accounting and audits, I wanted to first off crush the myth that auditing is a bad thing, meaning that when a company gets audited, they did something wrong or someone tipped somebody off and they need to get audited. Most companies or organizations, government agencies, have to get audited either every year, every other year, or every 3 years to keep running their business. Like, it's a requirement. So it doesn't mean anything bad. And I feel like the biggest reason people assume that it's bad is because the way that the IRS audits individuals. So if your Grandpa Joe is getting audited by the IRS, then yeah, that potentially could be a bad thing. He could be in some tax evasion, tax fraud, or he could come out clean and they could prove everything. So that still doesn't have to mean a bad bad thing. But for companies and organizations, getting audited is a good thing. It just means that all the auditors are coming in to make sure their financial statements are accurate. So speaking of financial statements, I'll give you guys a brief background if that's an unfamiliar word for you. Every single company out there has financial statements. Some other words that financial statements can be called is the books, the records, the financials. That all means financial statements, which are the asset, the liabilities, the debt, the revenue, the expenses. All of that is going to be listed on the financial statements, as well as the notes to the financial statements, which are supplementary to the statements that break things down where the average Joe can understand. So like, for instance, on an income statement, you'll have a few expenses that the company has, and it may be like millions of dollars, where in the notes, it'll have breakdowns of tables and charts breaking down the millions of dollars, so you have more of an idea specifically of which expenses the company has, whereas the actual financial statements as a whole is more solidified, more simpler. The notes are super long. Like, for instance, my client right now, the notes are over 50 pages to give more information and clarification on the financial statements as a whole. So you may be like, awesome, they've got financial statements, that should be good to go. Except for you don't really know if it's accurate. Considering the company is creating their financial statements themselves, that's where the auditor comes into play to come and make sure that the amounts on the statements are accurate and concise. So the reason auditors need to come and check and make sure that the financial statements are accurate are for the plethora of individuals involved in a company's financial performance, such as investors. If you own stock in any company, you are an investor in that company. And if you hold a lot of stock, you're gonna wanna make sure that that company is performing well. I'm gonna pop in again and mention that when we audit the investments of some of our clients, we even request the audit reports for the companies that our clients invest in to make sure that the companies have good financial standing, so we can say that our audit client is being wise on their financial decisions on who they're gonna invest in. So the audit reports go a long way. A lot of people look at them, and people you wouldn't even assume. And also public companies, those are all published online. Anybody can look up Apple or Starbucks financial statements. You can find them, just Google them. Google's another example. Private companies, you can't access them. Private colleges, universities, you can't see them. But if you're a donor, or if you have any reasonable reason that they would let you see the financial statements, then you can. And these companies are gonna have a lot of debt. They're gonna need to borrow money for their buildings or equipment or whatever it is. And those financial institutions, being the creditor loaning them money, are gonna wanna make sure that the company's gonna be able to pay them back and make their payments. And government organizations need to be audited because of all the federal funding or state funding coming in to help them run. And even if you have a private company or it's family owned and they're pretty much self-sufficient, they don't need any help, they're still gonna need insurance coverage on their buildings or vehicles, and that insurance company is gonna wanna make sure that they're gonna be able to make their payments and that they're insuring a building for good financial performance, or they may not. And a lot of not-for-profit companies still need to be audited because they're gonna receive a lot of donations or private donors, and those donors are gonna wanna make sure they're giving money to a good organization. So you guys probably get the gist. It's very important that the financial records are accurate. So how do these investors, creditors, lenders, insurance companies, donors, how do they know that a company's performing well? Well, they're most likely gonna request and read the audit report for that company. And the audit report is written by the auditors. The auditors give an opinion at the end of their audit saying if things are fairly stated or if they're not, and that's what they're gonna go off of. So that's where I come into play. So as an external auditor, that is my job, is to look over financial statements and make sure they're accurate. And I don't want this video to get too deep in the weeds because I can end up on a rabbit trail easily, because this is my job and I am passionate about it. So within auditing, it is absolutely not possible or feasible to test every dollar of a company coming and going. Even a small company is just not worth anybody's time. So that's why in every and all audit reports, you will never see any clear statements saying no fraud here, no misuse of funds, or accurate financial statements. That's not going to be in there, because since we didn't look at every single dollar, we can only say without a reasonable doubt that we didn't find any non-compliance or fraud or anything like that. So you're going to see in the report that it says auditors are reasonably certain that the financial statements are fairly stated. That's going to be the key terminology because not every dollar is being looked at. So how do we decide how much money is enough money to look at, or how much money is going to make a difference to the financial statement? That's called materiality. And materiality is a foreign term to 90% of the world, but in our profession, we use it every single day. So materiality is the smallest dollar amount that would change the financial statements of that company and make them misleading. That's Evan Muncie's terms. Let's look at what the actual definition is. So on accountingtools.com, in accounting, materiality refers to the impact of an omission or misstatement of information in a company's financial statements on the user of those statements. An omission would obviously be a missing item in the statements, and a misstatement would be if it's inflated or deflated. If they increased assets or if they increased revenue, that's typically what you'll find. Or if they've lessened liabilities, lessened expenses to make their net position or owner's equity higher than it should be. So that was a lot of words, but an actual example would be, let's say the owner's equity for a company where the net position is $500,000. $500,000, they're doing really good. That's all in the green, it's up, positive. And let's say that the auditor came in and found $1,000 of asset that should have been depreciation. So it should have decreased the asset, but instead they increased the asset. Is that material? Probably not. They're still going to document every single thing that the auditor finds is going to be added up at the very end of the audit to add it up to see if it's a material amount. But the $1,000 loan is not going to change the integrity of the financial statements. But let's say that that same error was $50,000 where it should have been in depreciation, decreased the asset, but instead it increased the asset. Is that material? Yeah, that's going to be material. So the auditor is going to note every single thing that they find, and at the very end of the audit they're going to add it all up, and if it's over the big material amount, that's when the financial statements become misleading. I wanted to pop in and say that I have talked a lot about misstatements within all these issues the auditors may find, but pretty often misclassifications happen, meaning that like a revenue item was put in this category of revenue instead of this category of revenue. Maybe it was non-operating, it should have been operating. That happens all the time, at least with my clients, and it doesn't affect the ending net position amount, meaning that if whatever they ended up having at the ending balance of their owner's equity net position is still going to stay the same. Obviously, because it's still revenue, it's still an issue, it can still be a finding, because they can mislead users of the financial statements who are looking in the notes, wanting to see how much revenue is in all the revenue categories. If there's like a material amount that's in the wrong category, that's a problem. Also, I should note that auditors come into a company to look at the financial statements after the books are closed. So they're going to be coming in that client's next fiscal year. So the timing of that can get finicky when the client is wanting to book the changes in the year of the error or mistake, but they can't because the books are already closed. So if it is a large material amount and they need to make that change for the financial statements to be accurate, they're gonna have to post a prior audit adjustment, which is gonna throw off all the beginning balances of the current year that they're already in. And it kind of gets a little hairy, and that even can complicate more errors because it's kind of a weird situation. I've seen that. So the timing can be weird, but the point of the auditors coming in is because the financial statements are already issued, they're already out there. If they send them to anybody, it'll definitely say in all big red letters, unaudited financial statements, so that the users of the financial statements know that, okay, the auditors have not looked at this, we don't know if it's accurate to their knowledge. So you guys may be wondering, what does auditing practically look like, or what would I physically look at on a day-to-day basis as my job? So let's say on your financial statements you have all your assets, all your liabilities, all your equity. One of the assets line items for any company is going to be cash. So the auditor would then look at the cash line item. Let's say it's $2 million that they have in cash. The auditor would request all the bank statements that the company has, all of their outstanding checks, all the NSF checks, and all of the little adjustments that are going to be in cash. The auditor is going to calculate a cash amount. So that auditor's total should match the line on the financial statements, and then it's good to go and you move on to the next thing. That is what's called substantive testing, because it is the money values that the auditor's testing, but you'll also have controls testing within cash, which means on every bank statement or every bank reconciliation, the auditor's going to make sure that it was reconciled by somebody that has the authority to reconcile the bank statement, but then that it was also reviewed and approved by somebody different than the preparer of the reconciliation, and that it was done within 30 days or whatever the client's standards that they're following. So that's going to be a controls test work that's within cash. Every single section of an audit has a lot of different test works that are involved, so it's not just like checking the dollar amount. And so I audit a lot of colleges and universities, so one of my favorite test works to do, I'm kind of nerdy about it, is the indicated tuition revenue. So I request all of the head counts from the college and university, so every single student that attended that semester, and then I'm going to take their fee schedules. So on their fee schedule they'll have like $600 a credit hour. So if they took 3 credit hours, it'll be $1,800, and then 6 credit hours, 9 credit hours, and then usually 12 and up is the same because that's full time. But anyways, I'll take that fee schedule, I'll apply it to every single student, how many credits they took, and it'll be this giant workbook with like 15 tabs on it in Excel. And then I'll have a grand total at the end that I'm matching to their accounting records in their system, which then matches to the financial statements. And there's going to be a difference. It's never going to tie down to the penny, because if you just can practically think about it, maybe somebody's dad works at the university, so they get half off tuition. And then you have a lot of kids who dropped after the drop date, but before the withdrawal period, so then they had to pay like 75% tuition or 50% tuition. And it's just not feasible or worth anyone's time to take every single student when you're talking like 30,000+ students to figure out everyone's unique situation and how many dollars they pay to the college. But our test work requires us to take a 5-year historical trend so we can see what the difference was between the auditor's amount and the actual financial statements for the past 5 years. And if it's within that same 20% difference, and it's most likely okay. Hopefully that made any sense at all. Another test work that is really important and kind of varies everywhere we go is accounts receivable balance, because it's net with the allowance for doubtful accounts, which is the money they expect not to receive that they kind of gave up on. And that calculation is really just up to management's decision. So I think the AICPA gives them like 3 different ways they can calculate ADA, and we don't care what way they calculate it. We just make sure that whichever way they chose, it was calculated correctly. So they have like an aging schedule, meaning that for the first 30 days, they'll probably expect to get like 80% of students to pay their bill. From like 30 to 90 days, maybe they're only expecting like 40%. So then they take all the money they expect to receive and they net it with accounts receivable balance. Again, getting into some details, but that just kind of gives you an idea of how we test those account balances. So every single audit firm, audit organization is set up a little different. Every state is set up differently. Since I'm a state auditor, that's what I'm most associated with. And we also have separate information systems auditors, and that's a whole separate division where they come into our clients and make sure that their accounting system is set up correctly, that journal entries entered require a different approver or reviewer than the person who prepared the journal entry. We make sure that they have a disaster recovery plan. I said we. I don't do any of that. I'm not skilled enough to know anything about the computer systems. I'm just trying to go off of what I know. And IS audit is very important, because if the accounting system that we're getting records from and trusting that that information is correct, if it has any material weaknesses or problems with it, then how can we trust anything that comes out of it? And like I mentioned earlier, there are also performance auditors. And the biggest difference that I can say is financial auditors are making sure that the money on the financial statements is accurate and right, but the performance auditors is making sure that the money given to certain institutions was used effectively and efficiently. So let's say that the US Department of Health gave my client $1 million for whatever reason. So we would make sure that it was put in the right fund or account in the accounting system and recorded timely, whereas the performance audit team would make sure that that $1 million was used for the right students or right staff, or whatever the reason it was supposed to be used for, it was used appropriately, and also that it was used efficiently and there was no fraud, waste, or abuse involved. And that's why performance auditing is a big thing in the government, just because of all the taxpayer money that's being used in any government organization. It is important that it's used efficiently and effectively, because we don't want to waste taxpayer money. So I asked my friend Darren, who works for the federal government, he's kind of a performance auditor there. I asked him how he would say the biggest difference between financial auditor and performance auditor, and he said I would basically just say that financial auditors ask, is it right? But performance auditors ask, can it be better? So that's the best way to put it. And lastly, at the end of any external audit, the auditors are going to issue an opinion, which goes in the audit report. So there are only 2 different types of audit opinions that can be issued in an audit report. You have an unmodified, which just means it's good to go, it's a clean opinion, everything looked great to the best of our knowledge. Then you have a modified opinion, which can come in 3 different forms. So the first one would be a qualified modified opinion, which basically just means that there was 1 or 2 account balances that were materially misstated, that had issues. So the audit opinion would say something like, except for cash and equipment, the financial statements appear fairly stated to the best of our knowledge, something like that. Adverse modified opinion is kind of bad, because it means that no, these financial statements are not really good to go. It was very materially misstated in several sections or several different parts. And then a disclaimer of opinion, really you just don't know the disclaimer. That means that the auditor did not have enough information to make an opinion on the financial statements, whether that be that the client didn't give the auditors enough information to go off of. Maybe they had a huge fire and all of their accounting records burnt up in flames, never to be seen again. I mean, now everything's digital, but back in the day that'd probably be a risk. But it just means that the auditor doesn't know if it's materially misstated or not. But anyways, you guys, yeah, that's what an auditor does. That's what auditing is. If you want more details about the job itself, just like the fact that I traveled last week, most auditing positions do require a lot of travel, stuff like that. I did a whole video about a state auditor. That may not help you if you're trying to go into Big 4 or any kind of public accounting, but I did talk all about my job description as state auditor in an old video, so I'll link it above. But yeah, you guys, I hope at this point that you're able to sort of understand what auditing is if you had no idea before. It's kind of hard to just explain to a stranger, but thank you guys for making it to this point. Hopefully you were able to learn something throughout this video. That's the whole point. It's also taking me literally all day to film this video because of all the distractions outside. They're literally pressure washing my building. And now the train's driving by. This is the loudest day I've ever lived at this apartment. Anywho, thank you guys so much for watching. If you're new here or you just subscribed after this video, then welcome aboard, but I will be taking a little brief break as I'm on a missions trip in Africa coming up soon. I'm really excited. But in the meantime, I do have a couple videos planned for you guys that I'm hoping to get up before I leave, but I'll definitely be back on YouTube when I get back. So look forward to that. I'm super pumped myself. But anyways, you guys, I'll see you guys next time. So thanks for watching, friends. Bye.